I have a couple businesses myself, and I can hardly be on the executive board of my own businesses, let alone someone else's. Would you just tell most people to just steer clear of a lot of these stocks? I mean, Paul says a lot of times if it sounds confusing, just buy SPY and live a great life. It's leading into my second question. With the world being so quick nowadays, quickening, you can buy a stock in the next 17 seconds without knowing anything about it, and it's just easier for normal people to do it. Would you advise normal people getting into these? I mean, how many normal dummies out there can know a company to the point where they could be on the executive board? I mean, what do you think about that?
To people inclined to stock pick, I think the value method is worth using because over long periods of time, it seems to be what works best. That's a very difficult message to sell, given what's happened over the last 5 years, where momentum or growth seems to have carried the day in the short recent history. But value works best. So inclined to stock pick, value for sure. But most people are not inclined to stock pick. Most people just kind of want their investments handled. For them, low cost stock index funds invested in at routine intervals of time seems to be what works best. That's actually a big point of the second book that I wrote, which is coming out now, Small Steps to Rich. Most people don't want to stock pick. They just want to, have personal finance handled. And, we're lucky this decade, as opposed to 6 decades ago, when we didn't have low cost stock index funds. They just have historically worked great, and I expect will work well going forward.
So, Kenneth, the hardest part for me is the discipline and the patience. Again, I go back to it seems as though every time I say it seems like young kids are changing, Paul would say, well, it's always been this way. But just the speed at which things are happening, the news is churning back and forth. What are you seeing in new investors in terms of, I just still struggle with that patience and discipline to stay with this value investing when everyone else is just slaying it on Bitcoin and Tesla?
I don't feel the sort of urgency that your voice would suggest exists. I don't have a smartphone, for example.
What?
I log on to social media. I don't. I mean, this is not popular, but and it's a routine source of amusement for people around me. Sometimes a routine source of embarrassment for people around me. But I don't need a constant stream of clickbait to divert my attention. And there's a lot of media I don't take in. I don't own a television and haven't for years. So I haven't owned a television since 1992.
Wow.
Yeah. I mean, there's just a lot that I turn off. So, the characterization of young people being sort of pressured to act and all this data that's flying around, I just don't take a lot of that in.
Mm-hmm.
And I find that...
Are you married?
It's complicated.
Paul has the same.
Yeah, I'm the same boat. Don't worry, mine's complicated too.
No, but I hear what you're saying. But I mean, you got to make these decisions to think clearly. I think one of the most precious things in personal finance and in investing is clarity of thought. And so anything that can sort of deliver that is worth pursuing. Mm-hmm. And I find that if I constrict the media I immerse myself in, that has a really positive effect for how I think, for what I think about, for my general frame of mind, for my general optimism. I appreciate that gets into sort of like lifestyle, but I mean, that's a very big deal. It's to the point where if I go to a party or to someone's home and there's a television on, I have a difficult time focusing on anything else. Because televisions when I was a kid were like,
the tube.
Something like this.
Yeah. Tube, yeah.
Now it's like the wall, right? Uh-huh. and the way these things are produced, it's like screamy and shouty and lights and emoticons and all of it. I can't possibly talk to someone when this is going on. So, I've sort of, sequestered myself away from a lot of media to the point where I will act unusually when it's around. But I wouldn't trade that for anything. I mean, that's had a real productive way on the way I just think about things.
Well, the reason I asked you if you're married is because, so I have a significant other, and she really buys into my thinking process, and we talk a lot about this. But I got lucky. I met her later in life after my value investing had really become a big part of me. But I wonder if somebody had gotten married, if I'd gotten married to somebody before this had taken place, would there be? I mean, because this is I've noticed that us value investors live a lifestyle very similarly. Like I'm not, I sat in front of my 85-inch TV yesterday and watched a show about Saddam Hussein. I mean, this was, and Chris Farley. So obviously it's a lot different than you, but.
Sorry, a single show about Saddam Hussein and Chris Farley?
Yes, it was a combination.
What network is this?
This is Hulu. I was watching the documentary about Chris Farley, and I was done with it. I watched the Saddam Hussein. But I have no TV.
Okay.
I have no TV in my bedroom. And
so it's sort of a double header, right?
Yes, It was a double header. I was like, listen, let me pick both extremes here. Let me pick terrible tyrant dictator. So I was born in Iraq, so that's why Saddam Hussein thing kind of appealed to me. And and I'm a comedian. No, I'm just kidding. But then I have no TV in my bedroom because when I'm in my bedroom, I just want to read. But I do know that if my significant other becomes part of my life and moves in with me, guess what's going to happen? We're going to get a TV in the bedroom because she likes to fall asleep with the TV on. So that's a very small microcosm of the entire idea of value investing. Of when I do see that we disagree on things, it's usually in things having to do with money because we view money very differently. But the great thing about the psychology of money is it allows us now to talk about how do we view money differently and come to a common ground of it. So that's why I asked you, you're older than I am. By the way, my significant other is older than I am. I just look at it, merging lifestyles together. Was yours? Yeah. I don't know. That's the reason I asked about the marriage thing. I didn't want to get into the.
No, it's a fair question. I've been fortunate in finding compatibility in the area you're talking about is very important.
Yes, very much.
It really is. By the time you hit 25, 30, 35, 40, your financial profile is kind of set. You have a certain relationship with consumption. You have a certain relationship with borrowing. You have a certain relationship with investing, insuring, planning, everything that Small Steps to Rich, the new book, talks about. I mean, you know who you are in those areas. And to be with someone that doesn't share that basic orientation can be challenging.
Yes.
And to find someone who does is absolutely a positive experience. People can learn, though. People can learn. I think, with the new book, one of the things that really motivated me to write the new book is that so many people handle their personal finances poorly. And I started to dive into, why is that? I mean, this is personal finance mastered is such a ticket to a happier life. And it's totally masterable. It's not like quantum mechanics or something. It's not difficult in that way. And it levels you up just hugely. So why wouldn't everybody pursue this? What I came to see is that there's fundamental truths about economic life that people either kind of get or kind of don't. I identified 8 of them, and the book starts with those. Risk, for example. In investing, as we know, risk is commonly associated with volatility.
Yes.
The degree to which an asset's price has moved historically. Value investors, by and large, reject that idea because 100%. They know that risk is just like the probability of loss. That's, after all, what our definition of risk would be in other spheres of life, like trying to steal a second from first base or something like that, the risk of being tagged out, as I talk about in the first book. So, risk is one example of one of these 8 economic truths. You either understand risk as the chance of loss or you miss that. But trying to function with personal finance as your field without an understanding of that and the other fundamental economic truths, it's very difficult. So I really focus in the book at the beginning of it on these 8 fundamental economic principles, and I'm hopeful that I'm able to convey those without scaring anybody away into thinking that it's a psychology book or something. But if you get those down, messing up in personal finance is very difficult because suddenly the unconstructive moves look revolting. Like you would never do that.
What are you seeing as you teach at Stanford? What are you seeing out of young folks in terms of being open and honest within their families about money? I talk to many people in this world. They're 40 years old. They still have no clue what their parents really do as they enter retirement, what they ever did, how much money they made. I am so open with I have 2 young kids, 11 and 8. I don't know if I'm overly open with them about the idea, like if they want something, it costs money and I have to leave them to go make this said money. And so what are you seeing now? And what are you seeing and how is this, is it healthy? Obviously, I think it's healthier to talk about money. What are your thoughts on it?
Well, the first thing I should say is that the course I teach at Stanford is open to all comers. One does not have to be a regularly enrolled Stanford student to take it. So the age
wow.
range of the
That's
students I teach goes up to like 75, I would say.
Right.
So it's a broader swath of the population. It's typically Stanford associated people or people here in California, but mostly here in California. But so when they come to my class, they're sort of pre-selected as into it. You know, nobody takes this because it's required for their bachelor's degree or something like that. They take it because they want to improve in their personal finances. And the interest they have in it as a result is pretty high. So the success is going to be pretty good there. With the book, what I hope to do is reach out to people who are more marginally interested in doing what's necessary to improve their personal financial situation. And so I've tried to make it as unthreatening as possible. It doesn't have tiny type, which is a design feature that I think turns people off from a lot of books that deal with the topic they're only marginally interested in anyway. It uses simple language. It doesn't require a certain background or, professional line of work that one is in, or even English as your native language. It's written that simply, I think. So hopefully I won't turn anybody off with the way that it's been written.
That's great. I hope it gets to kids. Paul and I teach at our local high schools, and it's
yeah?
incredible. Going off what Seth said, it's incredible. I will go in my first day and ask students what dynamic they have with their parents, what their parents do for a living. And there's kids in the school. Yeah. This is at a pretty affluent school. They don't know what their parents do for a living, and they're 16, 17, 18 years old. So it's great that you are writing a book like this. I hope it gets to those younger kids. That's what we want to do with this channel, is eventually get to kids.
Yeah, work. You're talking about parents knowing what their kids knowing what their parents do for work. One of the spheres of personal finance, as I identified, is work. And one of the things I try to make a point of is that work is not the primary source of wealth for most people because of the way ordinary income is taxed.
Right.
And I think that's a common misconception among young people and working people, is their personal financial situation will improve if only their salary went up. Well, you can wind up getting clipped between state and federal taxes 50% on ordinary income.
Yep.
Which is very different than the kind of taxes you face on a long-term investment gain, or more to the point, on an appreciating asset that you don't have a realized gain in. I mean, that's not taxed at all, because in the U.S. we still don't have a wealth tax of any sort.
Yet.
So, well, there's been proposals, but there's always been proposals for that.
Oh, I didn't know that. I thought it was just a recent thing.
Oh, no. That's happened before. We've seen that. And I appreciate the sentiment that leads to that recommendation. In the end, I think, people are going to perceive it to be basically against the fabric of the republic, because by one view, it's sort of double taxation. You're taxed on the income when you make it, and then you're taxed on your worth once you have it. But it depends how that rule is sort of, how that gets made or if it gets passed. I have a perfectly random record when it comes to predicting political outcomes, but I guess I would say that I would be somewhat surprised if some broad version of that rule came into effect.
Right. So, personal finance. So when I first became a value investor, I had this staunch, this is the way it is. And as time has gone on, it's become more of a accepting of, hey, this is just one way multiple ways to skin a cat is something I took from a value investing friend of mine that I've kind of, sat there and said, okay, now the same with personal finance. I used to have I'm going to save, 90% of what I make. And now it's become more of listen, I'm going to enjoy my life, but the things that don't matter to me, I'm going to be very tight on. And the things that do matter to me, I'm going to be a little more liberal about. You know what I mean? Those are the things that I have found a lot of comfort in, of saying, hey, I'm a wealthy person. I used to believe as a wealthy person, I need to do everything to the nines. And now I'm looking at going, no, this shirt right here was on sale at Banana Republic at the factory out. So it was not only at the factory outlet, it was on sale at the factory out. But then I have a collection of watches that's just an obscene collection of watches, because
you're a watch collector. How many watches you got?
22. Oh, look at that. 0.
Nada.
Not even.
What do you use them for?
So you don't watch
fashion?
He ogles them.
To me, they're pieces of art. To me, I buy
true.
nice watches that are that are like, to me, they're pieces. Like, it's so funny. My father says the same thing. He comes in my watch collection. He goes, what the hell is this? And I say, and I look at it. I one time said to him on Christmas, last Christmas, he saw them. He goes, what is this? He goes, this is a waste of money. I go, Dad, I'll tell you what, I'll double you. Bet me right now I could sell these for double what I paid for them. And of course, to my father, an immigrant from Iraq, he heard that. He goes, oh, okay, that's good. But to me, I like watches. But I also buy every car used because it's not important for me to have a brand new car. Even though I can afford any car in the world, I look at it going, yeah, but why should I buy a brand new car when I could buy a used one that's a year or two old and pay 30% less? So that's where I look at it and go, am I being a hypocrite? Am I not being a hypocrite? Well, to me...
No. What you've done is something that Small Steps to Rich recommends, which is drawing the distinction between needs and wants.
Well, it's all
this
wants.
Isn't a sphere.
It's all want. I mean, I don't need 22. I don't need 22 watches. I want nice watches, but at the same time, I look at it going, this weekend I sat there and said, I need to sell several of these watches because I don't wear them. I wear them once a month. I'm like, no, I don't need to. If I wear these once a month, I don't want it in the collection. But there's other ones that I gravitate to that I wear twice a week.
Well, consumption is one of 6 major spheres of personal finance.
Of course.
And spending. And, one of the things Small Steps to Rich encourages people to do is to draw this distinction between needs and wants. And the trouble is that they both feel the same at first. They both well up as impulses demanding to be served. The fact of the matter is that usually when we feel that impulse, it's a mere want, which means it's going to go away.
Correct.
If it's a need, it persists. And so what the book recommends is that you have some sort of waiting period. It can be a waiting period based on a product you want to buy, or it can be a waiting period based on cash you come into, whereby you hang on to it before you spend it. But either way, if you just wait a bit and you get to decide what the time period is, a day, a week, a month, you will find that the mere wants dissipate and it's the needs that stick around. And if you respond only to the needs, I think you wind up buying products that make sense for you to buy and not buying the ones that just sort of clutter up your life.
So it's funny.
I think what you don't... Yeah,
no, go ahead. No, you go ahead.
Well, I was going to say, I do not think it's the route to happiness to clutter up your life with unnecessary subscriptions and exercise equipment that never gets used and just all this sort of stuff. And there's been research on this by psychologists who note that a messy life is one that can become difficult to enjoy.
Oh, my goodness, yes.
Oh, absolutely.
Definitely.
And I've even heard a saying, and I don't know, I want to say it's from Japanese thought, but I'm not sure. It's something like, if you own 100 objects, you own them. But if you own more than 100, they own you.